Hey everyone! Today, we're diving deep into the world of personal finance, where we are going to learn about 7 important accounts that are very significant for you to organize your finances effectively. Managing your money can sometimes feel overwhelming, but having these accounts as your financial toolkit can make a significant difference in achieving your financial goals. While you may not have or need all of them immediately, but there's certainly something you should consider having in the long run. So, let's dive into these accounts. 1. Emergency account. Let's start with the emergency account, which is your ultimate financial safety net. This account is the first line of defense against unexpected financial crises, and it's crucial for anyone looking to secure their financial future, regardless of their job or income level. The primary purpose of an emergency account is to cover unexpected and unplanned expenses that life throws at you. This could include medical emergencies, car repairs, home maintenance, or even job loss. Having a dedicated fund for these situations ensures that you don't have to rely on credit cards or loans, which can lead to debt and financial stress. Now, how much should you have in your emergency account? Determining the right amount to have in your emergency fund can be a bit tricky because everyone's financial situation is different. However, a general rule of thumb is to aim for 3 to 6 months' worth of living expenses. Let's break this down a bit. 3 months, this is a good starting point for those with stable jobs and low risk of major financial disruptions. It can cover smaller emergencies like unexpected medical bills or car repairs. 6 months, if you have a less stable job, higher monthly expenses, or additional financial responsibilities, such as supporting a family, you should aim for a more substantial emergency fund. It provides a more comprehensive safety net in case of job loss or other significant financial setbacks. So, what account type should you use for your emergency fund? You'll want to choose a safe and easily accessible account for your emergency fund, and this may be a high-yield savings account or a money market fund account. But why are these accounts specifically recommended? A high-yield savings accounts offer a combination of safety and better interest rates than traditional savings accounts. The high-yield part means that you'll earn more interest on your money while still having easy access to it. The safety aspect is essential for your emergency fund because you want your money to be secure and liquid when you need it most. Money market fund, on the other hand, are mutual funds invested in short-term, low-risk securities like treasury bills and certificates of deposit. They provide a slightly higher return than regular savings accounts, but they may come with slightly higher minimum balance requirements. These funds are also highly liquid, meaning you can access your money quickly and easily in an emergency. 2. Investment savings account. This account is all about taking your short-term and mid-term financial goals and turning them into reality. Its main purpose is to serve as a dedicated space for you to set money aside for specific financial objectives that go beyond your regular monthly expenses. To make the most of your investment savings account, you should establish clear savings goals. These objectives could be anything from saving for a down payment on a house to funding an epic vacation or even buying a new car. By doing this, you can avoid dipping into your emergency fund or taking on debt when these expenses arise. You might be wondering, what types of accounts should I use for my investment savings goals? Well, it's essential to match the timeline of your goals with the type of account you choose and your risk tolerance. If your goal is relatively short-term, within a few years, consider using a regular savings account. However, if your goal is several years away, you could opt for separate high-yield savings accounts as they offer better interest rates, which means your money will grow faster. Also, you may consider certificates of deposit, CDs, if you have a specific date in mind for your goal and you want to earn a higher interest rate than a regular savings account. However, keep in mind that your money will be less accessible until the CD matures. Remember that investing always carries some level of risk, and it's essential to do your research or consult with a financial advisor to make informed investment decisions that align with your goals and risk tolerance. 3. Sponsored retirement account. Moving on to our third must-have account, we have the sponsored retirement account. The name may vary depending on where you are in the world. In the United States, it's commonly known as a 401k. In Canada, it's the Registered Retirement Savings Plan, RRSP, and in the UK, it's often referred to as a workplace pension. Regardless of the name, the purpose remains the same: to help you build a secure retirement. This account is a key player in building a comfortable retirement and mostly offered by employers, so, if your employer offers one, you should definitely take advantage of it and open one. The primary purpose of a sponsored retirement account is to save for your retirement years. These accounts often come with significant tax advantages, making it easier to accumulate a substantial nest egg over time. When it comes to your sponsored retirement account, you should aim to contribute enough to maximize any employer matching contributions if available. Employer matches are essentially free money, so it's wise to take full advantage of this benefit. Additionally, you should strive to consistently save a percentage of your income, ideally around 6 to 12% or more, depending on your age and retirement goals. Your sponsored retirement account is typically managed through your employer's chosen financial institution. You'll have the opportunity to select from a range of investment options, such as mutual funds and target date funds. It's essential to regularly review and adjust your investment choices based on your risk tolerance and retirement timeline. Regardless of where you are, the key to maximizing your sponsored retirement account is to take full advantage of any employer contributions and consistently contribute a percentage of your income. These accounts are typically tax-deductible, meaning they can reduce your taxable income for the year. Additionally, your investments grow tax-deferred, which allows your money to compound more effectively over time. 4. Individual Retirement Account, IRA. An IRA is a personal retirement savings account that allows you to save for retirement on your terms. It's an excellent option if your employer doesn't offer a retirement plan, or if you want more control over your investments. There are two primary types of IRAs, traditional and Roth. In traditional IRA, contributions to these accounts may be tax-deductible, reducing your taxable income in the year of contribution. However, you'll pay taxes when you withdraw the funds in retirement. This account is ideal if you expect to be in a lower tax bracket during retirement. On the other hand, Roth IRA contributions are made with after-tax dollars, so they don't provide an immediate tax deduction. However, your withdrawals in retirement are typically tax-free, making this option advantageous if you anticipate being in a higher tax bracket during retirement or if you prefer tax-free withdrawals. The savings goal for your IRA is to contribute annually up to the IRS set limits. Currently, the contribution limit for both traditional and Roth IRAs is $6,500 with an additional $1,000 catch-up contribution allowed for individuals aged 50 or older. The more you contribute, the faster your retirement savings will grow. Both types of IRAs offer a wide range of investment options, including stocks, bonds, mutual funds, and more. And the best part, you have control over how your funds are invested, allowing you to tailor your portfolio to your risk tolerance and retirement goals. 5. Health Savings Account, HSA. This account is a game changer when it comes to managing healthcare expenses while enjoying significant tax benefits. The primary purpose of an HSA is to cover qualified medical expenses while enjoying triple tax advantages. These triple tax advantages are tax-deductible, reducing your taxable income for the year, the funds grow tax-free, and tax-free withdrawals for qualified medical expenses. HSAs are often associated with high-deductible health insurance plans, HDHPs, and they serve as a way to cover out-of-pocket medical costs while offering tax advantages. It's important to note that not all HDHPs qualify for HSAs, so check with your employer or insurance provider to ensure eligibility. Your goal with an HSA is to contribute enough to cover current and future medical expenses effectively. Unlike other accounts, there's no specific annual contribution limit set for medical expenses. However, there are IRS-set contribution limits for HSAs, and as of today, the annual limit for an individual HSA contribution is $3,850, with a family HSA contribution limit of $7,750, and your contribution limit increases by $1,000 if you're 55 or older. So, how do you open one? To open an HSA, you'll typically do so through your employer if they offer one, or you can open one independently through a bank or financial institution. Once you have an HSA, you can invest the funds in a variety of ways, similar to an IRA or 401k. Some HSA providers even offer the option to invest in stocks, mutual funds, bonds, or ETFs within the account. This means that you can use your HSA not only for immediate medical expenses but also as a long-term healthcare savings and investment vehicle. 6. Brokerage account. This account is your gateway to building wealth, investing for the long term, and pursuing your financial goals beyond retirement. While your retirement accounts like the 401k and IRA are geared towards long-term retirement savings, a brokerage account offers more flexibility. It's a great way to invest money that you don't need for immediate expenses and allows you to take advantage of opportunities in the financial markets. The purpose of a brokerage account is to invest in a wide range of assets, including stocks, mutual funds, bonds, exchange-traded funds, ETFs, and more investment options available. Unlike retirement accounts, there are no tax advantages tied to contributions or withdrawals, which means you have more flexibility in how you use the funds. So, where do you open this account? You can open an individual brokerage account with a brokerage firm or a financial institution. When it comes to choosing a brokerage account, you have several options, including 1. Individual brokerage account. This is the most common type of brokerage account. It's a personal account that you can open with a brokerage firm, bank, or online brokerage platform that gives you full control over your investments and enable you to buy and sell securities as you see fit. 2. Joint brokerage account. If you're investing with a partner or spouse, a joint brokerage account allows both of you to manage and contribute to the investments. 3. Custodial account. These accounts are designed for minors, with a parent or guardian as the custodian. They are typically used for educational or financial planning for children. It's important to note that while you won't get the same tax advantages as retirement accounts, you also won't face penalties for early withdrawals, making this account suitable for both short-term and long-term goals. Also, you have the flexibility to create a diversified investment portfolio based on your risk tolerance and financial goals. Diversification will help spread risk and help protect your investments during market fluctuations. 7. Checking account. Now, let's explore the 7th account, which is perhaps the most familiar to all of us, a checking account. This account serves as your everyday financial hub, facilitating transactions, bill payments, and managing your day-to-day finances. It provides the ease to access to your money for everyday expenses. This includes paying bills, making purchases, withdrawing cash from ATMs, and transferring funds to and from other accounts. Most people have a standard checking account with a bank or credit union. These accounts typically come with features like a debit card, check writing capabilities, online banking, and mobile apps for easy access and management. It's worth shopping around to find a checking account that offers the features you need, such as low fees, overdraft protection, and access to a broad ATM network. Some checking accounts also offer interest, although the rates are usually modest compared to savings accounts. It's essential to manage your checking account diligently by tracking your transactions, monitoring your account balance, and reconciling your statements regularly. Many banks also offer tools and apps that can help you keep a close eye on your spending and financial transactions. One additional point to note is that some checking accounts offer interest on your deposits, although the rates tend to be lower than those of savings accounts. If earning interest on your checking account balance is important to you, shop around for accounts that offer competitive rates. Organizing your finances is not just about managing your money, it's about taking control of your financial future. Whether it's building your emergency fund, saving for your dreams, or planning for a secure retirement, each of these accounts plays a vital role in your journey towards financial freedom and stability. If you found this video helpful, please give it a thumbs up, subscribe to our channel for more financial insights, and don't forget to hit that notification bell so you never miss an update.